Right now, while you're watching this video, millions of dollars are changing hands every single second. And here's the crazy part. You could be part of it, but you're not, because nobody ever taught you how the stock market actually works. I get it. The stock market sounds complicated, intimidating, maybe even scary. But what if I told you that understanding the basics is actually simpler than learning to drive a car? And just like driving opens up a world of possibilities, understanding the stock market could completely change your financial future. In the next 10 minutes, I'm going to break down every essential stock market term you need to know. No jargon, no fluff, just clear explanations that'll make you say, "Wait, that's it?" By the end of this video, you'll understand what's really happening when someone says, "The market crashed," or "Stocks are up." You'll know the difference between a bull and a bear market, and most importantly, you'll have the foundation you need to start your investing journey. So let's dive in and demystify the stock market once and for all. What is a stock? Let's start with the most basic question. What exactly is a stock? Imagine you and 3 friends want to start a pizza restaurant. You need $100,000 to get started. You each put in $25,000. Congratulations. You each own 25% of the business. That's exactly what a stock is, a piece of ownership in a company. When you buy stock in Apple or Tesla or any public company, you're becoming a part owner of that business. If the company does well and grows, your piece becomes more valuable. If it struggles, your piece becomes less valuable. It's that simple. Now, these pieces of ownership are also called shares or equity. So when someone says they own 100 shares of Amazon, they own 100 tiny pieces of Amazon. The stock market. So where do you actually buy these stocks? That's where the stock market comes in. The stock market is basically a big marketplace like eBay or a farmer's market, but instead of buying vegetables or electronics, you're buying and selling pieces of companies. The biggest stock markets in the U.S. are the New York Stock Exchange. That's the famous one with the building and the bell, and the NASDAQ, which is entirely electronic. Companies list their stocks on these exchanges so regular people like you and me can buy them. And the beauty is, you can do all of this from your phone while sitting on your couch. Bull versus bear markets. You've probably heard people talk about bull markets and bear markets. These are super simple once you know the trick. A bull market means prices are going up. Think about how a bull attacks. It thrusts its horns upward. Prices going up, bulls going up. Easy to remember. A bear market means prices are going down. Bears swipe downward with their claws. Prices going down, bears going down. Specifically, a bear market is when the market drops 20% or more from its peak. When you hear, "We're in a bear market," it means stocks have fallen significantly and investors are pessimistic. A bull market is the opposite. Rising prices and optimistic investors. Stock price and market cap. Now let's talk about what determines a stock's value. The stock price is simply what people are willing to pay for one share right now. If Apple's stock price is $150, that's what it costs to buy one share at this moment. But here's the thing. The stock price alone doesn't tell you if a company is big or small. That's where market capitalization comes in, or market cap for short. Market cap is the total value of all shares combined. You calculate it by multiplying the stock price by the total number of shares. For example, if a company has 1 million shares and each costs $50, the market cap is $50 million. This tells you the company's total worth in the stock market's eyes. Apple's market cap is over $3 trillion. That's how massive it is. Companies are categorized by market cap. Large cap companies are the giants worth over $10 billion, mid cap are between $2 and $10 billion, and small cap are under $2 billion. Dividends. Here's something cool. Some stocks actually pay you just for owning them. These payments are called dividends. When a company makes profit, it can choose to give some of that money back to shareholders. If you own 100 shares of a company that pays $2 per share annually, you get $200 a year just for holding the stock. Not all companies pay dividends, though. Young, growing companies like Tesla usually reinvest all their profits to grow bigger. Mature companies like Coca-Cola often pay steady dividends. It's like the difference between planting all your seeds to grow more crops versus harvesting some to eat now. Index and ETFs. Now, buying individual stocks is one approach, but there's a smarter way for beginners: index funds and ETFs. An index is basically a scoreboard that tracks a group of stocks. The S&P 500 is the most famous index. It tracks the 500 biggest U.S. companies. When people say the market was up today, they're usually talking about how the S&P 500 performed. An ETF, or exchange-traded fund, is like a basket that holds many different stocks. Instead of buying 500 different stocks yourself, you can buy one share of an S&P 500 ETF and instantly own a tiny piece of all 500 companies. This is called diversification, spreading your money across many investments instead of putting all your eggs in one basket. If one company fails, you've only lost a small portion instead of everything. This is why most experts recommend ETFs for beginners. Buying and selling, market orders versus limit orders. When you're ready to buy, you need to understand two types of orders. A market order means buy this stock right now at whatever the current price is. It's fast and simple, but the price might change between when you click and when the order goes through. A limit order means only buy this stock if the price reaches this specific amount. Let's say a stock is $100. But you only want to buy it at $95. You set a limit order for $95, and if the stock drops to that price, your order executes automatically. It gives you more control but isn't guaranteed to fill. Most beginners use market orders for simplicity, but limit orders are useful when you want to be strategic about your entry price. Volatility and risk. Last key concept, volatility. Volatility measures how much a stock's price bounces around. High volatility means wild price swings. The stock might jump 10% one day and drop 8% the next. Low volatility means stable, predictable prices. Generally, high volatility equals high risk, but potentially high reward. Cryptocurrency and tech startups are super volatile. Established companies like Johnson & Johnson are much more stable. Your risk tolerance, how much uncertainty you can stomach, should determine what you invest in. If wild price swings keep you up at night, stick to stable, low volatility investments. The big picture. All right, let's bring this all together and see how everything connects. The stock market is where you buy shares, pieces of ownership in companies. These trades happen on exchanges like the NYSE or NASDAQ. When lots of people want to buy a stock, the price goes up. When lots want to sell, it goes down. Supply and demand. The overall market can be in a bull phase where prices are climbing and investors are optimistic, or a bear phase where prices are falling and people are nervous. Individual stocks have their own prices, but what really matters is the market cap, the total value of the company. Some stocks pay you dividends just for holding them. Others don't, but might grow faster in value. Instead of picking individual stocks, you can buy ETFs that give you instant diversification across hundreds of companies. When you buy, you use either market orders for speed or limit orders for control. And every investment has volatility. Some are wild roller coasters. Others are smooth rides. Your job is to pick investments that match your risk tolerance and goals. Why this matters. Here's why understanding these basics is so powerful. Historically, the stock market has been one of the best ways to build wealth over time. Sure, there are ups and downs. Bear markets happen, companies fail, volatility can be scary. But over the long term, the market has consistently trended upward. The S&P 500 has averaged about 10% returns per year over the past century. That means if you'd invested $10,000 30 years ago, it would be worth over $170,000 today, even after multiple crashes and recessions. That's the power of long-term investing and compound growth. But none of that matters if you don't understand the basics. You can't invest confidently if you don't know what a stock is, or how an ETF works, or what market cap means. These terms aren't obstacles. They're tools that empower you to take control of your financial future. So where do you go from here? The stock market isn't some mysterious club for rich people or financial geniuses. It's a tool, and now you know how to use it. If this video helped demystify investing for you, hit that like button and subscribe for more beginner-friendly financial content. Drop a comment below telling me which term made the biggest aha moment for you. Remember, every expert investor started exactly where you are right now. The only difference between them and you is that they took the first step. Now it's your turn. Thanks for watching, and I'll see you in the next video.